All right, good afternoon and welcome to today's training. My name is Nedu and I'm your Forex coach and facilitator for today's training at Profit Plus Trading Academy. And in today's training, we're going to be looking at chart pattern and analysis. And this is the strategy that the banks, the big boys, the big banks use in trading the market. And it's important, actually it's one of these is the strategies that they deploy in trading the market. And it's important that as a forex trader, you trade along with their strategy. You know, you follow their footsteps in whatever you are doing in the market. All right, so we are beginning with strategies now. We've been able to give you a brief introduction on forex trading, and then we started introducing you to some of the basic terminologies, technical indicators, and some tools. But beginning from now, I want to pay very close attention and listen very well and watch the videos over and over again until you understand the pattern. All right? Okay, so chart patterns are one of the most effective trading tools for a trader. They are pure price action and form on the basis of underlying buying and selling pressures. Chart patterns have a proven track record and traders use them to identify continuation or reversals, to open positions and identify price targets. Okay, so we have this pattern categorized in two categories. Number one is the continuation pattern, and then number two is reversal patterns. And at this point, I want to remind you of the three major trading environments in the market. And one of them is the uptrend, in which market price begins to make higher highs and higher lows. All right, uptrend, like you are ascending a staircase. That's the way price does in an uptrend. It makes a high and then it retreats. In trend analysis, it is called impulse and reversal, impulse on retracement. All right, the impulse is the price action in the direction of the trend. All right, while the retracement or pullback or correction is the action action against the direction of the trend. I want to show you something here using my this is S&P. I actually don't trade this particular currency. It's actually an index. I actually don't trade, but I just did an analysis about it, and around this area we predicted that it's going to move up based on something. All right, it's not for you, okay? All right. So what I'm talking about here in chart patterns, we're trying to get an idea of trends, uptrend, downtrend, like that. So this is an uptrending market. This is how an uptrending market environment looks like. All right, and you like this. This is how it looks like. Then the downtrending market, this is like you're ascending a staircase, and then of course you have to draw a line to join the lows. Okay?
You're not sharing your screen. Can you hear me?
You're not
sharing your screen. No. I'm not.
I'll correct that. Okay, can you confirm, Emeka, please confirm that you can see it?
Yes.
Okay. All right. So we continue. Now, this is an uptrending market environment. So, but it's not going to look as perfect as what you are seeing here. Okay. It's not going to look as perfect as what you. This is just an illustration. And when you connect the lows in an uptrending market, when you connect the lows, this is the lows. Okay. This is the high. Let me find high. Okay, and then we have the low. All right, and then we also have another high. In this time, it is called higher high, head check, higher high. Okay, and then this is the low, and then this one will be higher low. All right, higher low. And then you have another higher high. And then you have another higher low. You have another higher low here. So that's how it continues. This is what is called an uptrending market. Then, in the case of the downtrending market, you have it like you are now descending the staircase. Okay? I'm just using a freehand drawing. And I gave an assignment at some point for you to identify a downtrending market and uptrending market. So if you join these lows, if you join these lows, this line, so this line that we are joining the higher lows in the case of the uptrending market. All right. In the case of an uptrending market, it's called the uptrend line. So that line is called the uptrend line. This is as easy. Initially, some people think that it requires a lot of mathematics knowledge. So this is an uptrend line, this line. So when you join these lows, it gives you an idea. And there's a reason why we're using that trend line. Trend line, remember in the previous classes, that when the price breaks a trend line, it offers you an opportunity to trade in the direction of the break. And when the price touches the trend line and bounces off, like in the case here, so this is where you want to, when the price is anticipated or predicted to go up or rally higher, you are going to be looking for buying opportunities. So in uptrending market, what we are looking for is just buying opportunities, all right? And the point that you look for those buying opportunities, if you happen to see this trend line when it is beginning maybe around this area, all right? This is where you saw it. And the moment the price starts to go up, then you can buy the market. You don't come when it has made a high. You don't come here and buy when it has made a high. No, you don't buy here. You buy at the low, right at the bounce off. When the price bounces off from the trend line, this is where you buy. Price coming down and it bounces off. All right. And I also mentioned to you that this trend will not continue forever. A time will come when it will reverse. The time will come when it will break. It will break this line. A time will come when this line will be broken. All right. Price will come and break it. Price will come and break it. So when it breaks it, we begin to do what? To sell. Okay? When it breaks it, you begin to sell it. The price has changed direction. Okay? So as a forex trader, one of the most important things that you look for when you open your charts is to know direction. What direction is the market going? What actually is the market environment? Which market environment am I in on this particular currency pair or commodity or index that you are trading? What market environment is this? So where is the direction? And I also mentioned to you in some of those videos that you will need to do this in higher time frames. You can't find the market direction on 15 minutes or 30 minutes or 1 hour, that's 1H or 4H. From actually 4H, you can start from 4H, daily time frame, weekly, and again on. the monthly time frame. These are where you can actually locate the market environment. Okay? Now, we said that this is an uptrending market, and the second one is a downtrending market environment, and this time around you are going to draw the downtrend line at the highs, not the lows, at the highs. So this is the high, and you can see the next high is actually a lower high. This next high is a lower high. You can see, because at this point, this is this price. If you can get this to this area, you can see the price for this is $4,815, right? And then you can see at this point it is lower. This is 4,763. You can see here is the price. This is TradingView. I use TradingView to do most of my analysis, and I've also recommended that you go to www.tradingview.com to open a free account. It's free, and if you now wish to receive more features on your TradingView chart, then you can pay as low as $15 or $14 per month for that. And before you can pay for that, you should have started trading and making profits so that your cost of trading does not increase. Okay, so here again is our next lower high, LH. So we are drawing downtrend line, joining at least the very first 1, 2, 3 lower highs. The same thing for the uptrending market. We are joining the very first 1, 2, 3 of higher lows. All right. So this trending market. Then another environment is the environment that the price is not trending. It's called ranging. Okay. In this kind of environment, it's ranging between a support and resistance levels. Between support and resistance levels. So the lower one is the support, this higher one is the resistance. So we have here resistance, and then the lower is the support. Some people call it here, they will call here demand and here supply. Alright? So it's basically resistance and supply and support zones. So you can see markets move in this environment. This is the environment to move this way. It will get the resistance, it bounces, get support, it bounces up, gets resistance, this is how it's been doing, like this. Okay? And then here. So when you catch the market, when you are opening your chart, you are looking for, is the market trending on higher time frame, maybe 4 hours, daily, weekly, and monthly. You can find out. Alright? Let me show you an example in gold. Gold is actually giving us a downtrending market environment. You can look at this. This is gold. Let me put it on weekly. Alright. On both weekly and daily, you can see. Or let me put it on daily. It's more beautiful there. Alright, you can see the gold. This is a live chart. This is a live chart. Okay, just trying to remove a lot of stuff I put here. You can see the gold. This is a live chart here, and you can agree with me that this is a downtrending market, as we can join these significant highs. You can see them. can join them together. Alright? You can see how it's well fitted. So at what point in the downtrending market are you supposed to be looking for yourself around these areas? This point when the market moves. Try to pick it to sometimes around these points. Here. These are where you can pick your selling positions. When it touches the trend line, you can see this is gold. This is gold. And you can see that in this particular area, gold is ranging. Is ranging around here. You can see. You can see that it moves up, down, up, down. It really does not have any direction. I want to use one other thing to show you a good typical example of when the market is ranging. It does not have any direction. I think that's USD CHF. I'm monitoring that particular chart. Where is it? Okay, you can see it. You can see it. I did put a watcher here. You can see here. Let me get this. Lovely. You can see what the market is doing here. It did a beautiful, and here too. Look at here. This is another very beautiful example of when the market is ranging. Like I told you, it's not going to be that very perfect. You can see that. You can see it. It came all the way down, bump, up, down, up, down, up, down, up, down, and then after that it broke. Are you seeing that? It broke into this area. I told that market environment will not continue forever. Okay? You can see this on a daily time frame. It's a typical time that the market is ranging. So assuming that you discovered this when the market price was, maybe the structure was around here, just around here. It moved down here, got to this level, returned here. This is support now. Here is resistance. This place is your resistance. Alright? While the downside is your support. Okay? So you are going to be waiting until the price touches the resistance. You do what? You sell. When it gets the support, you know that you can take your profit. The market price will likely bounce up, and that happened. It got to this level of resistance again. You do what? You sell. When it comes back down, you buy. It got up, you sell. Came down, you buy. You see, until it broke away from this range. Remember, we told you that this thing will not last forever. Okay, this actually will be a range. Okay, here. The moment it broke away from here, see what happened. It got up. It did over how many pips? About 600 pips on one standard lot, $6,000. When this happened, it retraced again into another, started doing the same thing. It came down, up, down. So the market is ranging, does not really have direction until the day the market will break down here. Maybe it will come back and break here, or it breaks on the upside. Or it breaks on the upside. Alright? So right now, we can look for an opportunity to sell. That's why we have this here. Okay? An opportunity to sell the market. So we are expecting that price may likely also come all the way down to this point before anything happens. So if it starts to drop, we can join the trade and begin to sell. Alright? And let's go back to the previous place that we were. So this was our previous chart. So now there are three market environments established. The uptrending market. The market is making higher highs and higher lows, as in here. You are ascending the staircase. The downtrending market, when market is making lower lows and lower highs. So I didn't put this one here. This should be the low. And then this is lower low. Alright? So when it's consistently doing this, we call it a downtrending market. And you can see this, it is valid when you find it in higher time frames. If you see this type of scenario, market scenario, in 30 minutes, 15 minutes time frame, it is not reliable. Okay? It's not reliable, it can mislead you. Okay? So you locate it on higher time frame, 4 hours, daily, weekly, and also on the monthly. Alright, I did this to give you a background. I'm sure I've taught this in how to trade trending markets and also Twitter. There's a video like that which you have watched. I know I pointed that out, but I wanted to be sure that you have this before we begin to drill on. And this is the basic principle of the chart patterns. Firstly, when you open your charts, you are looking for the market environment. You want to get a direction. What direction? What's the overall direction of the market today or this week or this month? And you can find that by locating these three market environments. The first one uptrending, second one downtrending, then the third one consolidation or ranging market. Market moving between levels of support and resistance. It's moving sideways. All right. Now, in chart patterns, we told you that we have two categories of chart patterns: the continuation pattern and the reversal pattern. And it's self-explanatory by reason of the word that we are calling. Please confirm you can see my chart again. Maybe I'll need to share. Please, can someone confirm you can see my screen? Okay. Madam Kechi, can you confirm you can see my screen?
Yes, I can see it. I'm seeing it.
What are you seeing?
The patterns are categorized into two. Continuation pattern.
All right.
Continuation patterns and the reversal patterns.
Okay. So mean that everybody can see it and it's recorded so you can have your video secured. So that's the foundation. Now we are looking at those environments. If peradventure you saw it in the market is trending upwards, okay, it's doing like this. This is an uptrending market. If that was what you saw, and this market is moving in a direction, that's the direction. So to take advantage of this direction, you have to look for patterns that will suggest to you that the continuation is still valid, that it's still going to continue. That it's still going to continue. If you are climbing a staircase, there are some staircases. If you climb about 5 stairs, the way it is built, if you climb about 5 stairs, this is how that staircase is. I'm sure we know it. And then it will do something like to flatten out and then continue to do like this. Okay? There's a staircase like this. So here it flattens out so that it can rest. This is the flattened distance. Then before you continue to do what? To climb the staircase. There are some other staircases, it's just straight. You know, it goes straight from down to the room, then you are right there. There are ones like that. But this particular staircase pattern, when you climb 1, 2, and the third one is flattened. It's not, there is no door anywhere to enter. So it means the staircase is not ended. Oh, you look up, okay, there is a staircase. You continue to climb. So this particular sign here is a sign, this flattening of this staircase here is actually a sign of continuation in the same underlying direction. I'm sure you understand what I'm talking about. Alright? So that is what we call continuation patterns. Continuation patterns are those patterns that will show in your uptrending or downtrending market that suggests that this trend is still valid. It will still continue, markets will still continue in the underlying direction. Whereas the reversal patterns will show you at the truncation of the trend, when the trend is about to end. When the trend is ended, there are patterns that you are going to see in the market. So market is very, very transparent. It shows you exactly what it wants to do. So those reversal patterns, if the price is going up, you know, this is the uptrend, it will get to this point and do something like this, and now it's coming down. So when there's a switch over between uptrend and downtrend, there is what we call reversal pattern, and this is where the reversal pattern is located. Alright, this is where it is located, this area. So these are uptrending markets that reverse into a downtrending market. But for continuation patterns are seen within the trend, and they are seen as corrective structures around here, alright, that will guide the trader who has been trained on how to identify it, okay, to identify them and take advantage of them. And this thing has been historically consistent. Okay, I'll repeat again. Your trading on market environment is located on high time frames. This strategy for trading the forex market, you can apply it also in trading indices, in trading commodities, in trading stock. It's consistent. It's a record of the behavior. It actually gives us an overall trend, overall direction, thinking of everybody participating in the market. And as a technical trader, you may not be interested at this point as to what is causing the trend to reverse. But before the trend, whatever it is that caused it to reverse, you are going to see a sign. If you grew up in the village like myself, I grew up a village boy. We were living in town before we moved to the village to finish some things before we started moving up. Okay, so we did a lot of fishing and hunting not with guns but with traps. So before we start to set our trap, you don't just go and position your trap anywhere. You have to look for the tracks where the animals pass through, and we are trained on how to identify them. Again, before you set your trap on any hole to catch a grass cutter or maybe a rabbit, okay, it's not every hole you position your trap in front. You have to check. Sometimes you have to smell the sand. Sometimes you look around the hole to find out if there are some kind of friction. A lot of things to identify that the animal is in there. All right. So this, you can apply this strategy anywhere. It's consistent. It's about life principles. Okay. So whenever this signs, you find this sign, this is what it means. If this and this and this are present, this is what it means. So in trading the market as well, we have identified patterns, okay, structures. These patterns are structures in the market that you will see it from. Oh, what it means is that this trend is going to continue. So if the overall trend direction is bullish, that's upwards, okay, it means you have to be looking for buying opportunities. So if the market environment is bullish, is uptrend, you only trade buying opportunities. You're going to be looking for structures that will tell you that this trend has not exhausted and it will continue in that same direction. However, if you are trading in a downtrending market environment, you should be focused on identifying only selling opportunities. Why? Because the trend is your friend. It's easier to win trading. You know, the probability of your trade increases when you are trading in the direction of the trend. The probability of your analysis coming out true, it increases if you are trading in the direction of the trend. So when the market is trending upwards, what I'm basically looking at are opportunities to buy. If the market is trending downwards, what I'm analyzing for are just trying to identify structures, patterns that will suggest that this downtrend is continuing. In other words, I'm going to look for opportunities to sell or to short the market. All right. So that said, these patterns on the chart are categorized into two: continuation patterns that will tell us that the trend is still continuing, and reversal patterns that will tell us that the trend has terminated. All right, it's been exhausted, so there is a change. There's a change. All right, so let's move into the stuff now. Now, continuation patterns. Continuation patterns, we have two types of continuation patterns. We have the bullish continuation pattern and the bearish continuation pattern. Bullish continuation patterns are seen in an uptrending market, while the bearish continuation patterns are seen in a downtrending market. All right, and these are the continuation patterns. We have the one we call flag. Just like the flag. Flag, you know, these shapes, we are using things that you can immediately identify with. Flag, there's nobody that has not seen flag. Alright, when the flag stands, how it looks. Then we have rectangle. So this flag, we have the bullish flag and also the bearish flag. Then rectangle, we have bullish rectangle and bearish rectangle. Bullish rectangle is located in an uptrending market, while the bearish rectangle located in a downtrending market. Then we have the wedge, bullish wedge and bearish wedge. We have triangle, the bullish triangle and bearish triangle. We have the cup and handle, all right, cup and handle. We have the bullish cup and handle and the bearish cup and handle, or we call it the inverted cup and handle. And we'll be looking at some of those things that we mentioned now. This is the first one. This is the bullish flat chart pattern. Price is, the underlying trend is bullish. You can see that, you can see the arrows, it's pointing up. Alright, so this is an uptrending market. So, and I told you that price does not move in a linear form. It moves in a wave. Alright, it makes an impulse and then it corrects, it comes down, and then it moves again. It moves like a snake. You will not see a snake that is running straight. The snake, the body will just be moving like this, but it's going in a particular direction. That's how price of stock or currency, commodity behave over a period of time. And this particular behavior of price has been seen to be historically consistent. So you can see this is the impulse from year to year. You can see that price rose straight, it moved straight from down here to up here before it started to make what? A correction. It moved sideways. So you can see that this looks like a flag. That's why it's called a flag. Now, to trade this particular structure, assuming that from here has not shown, you just saw this and you've identified that the trend is bullish. Oh, this flag has formed. What is the flag? Oh, it's a continuation pattern. We are not selling. These two red candles, they are here to deceive us, thinking that market is coming all the way back down. Those who do not know these things, they will make a lot of errors. But you having to learn it at this time, you have an advantage. So what you do at this point is to join the highs this blue line. See all these lines? The only thing that you're going to see in the chart is those red candles and the green candles. Every other thing that you're seeing there is added. The arrow was added. The blue lines were all added. And you are the one that will do it. So the upper line, you join it, and that's your resistance line. While the lower one, you join it, that is your support line. So at the break of this resistance, you begin to look for opportunities to enter the market. I've shared with you on entry strategies, how to enter a trade. Usually price will do this. There are different entry strategies, and I will need to do another video for you on entry strategies. But basically for this, when the price breaks this resistance line, it usually will pull back. Remember, you are seeing this on a higher time frame, maybe on daily time frame. A lot of things must have happened in this candle. There could have been a time that the market moved up to this place, returned back here, and then before it started going up. And that's what the price usually does. When it breaks a particular level of structure, it breaks support or resistance, it usually wants to go there to retest it. And when the price breaks from a structure and retraces it, we call it confluence. All right, that's a previous level of resistance becoming now a level of support. So price will break it, return. So when it returns around this area, you do what? You enter your buy. You can enter your buy and come at the middle of this place to put your stop loss or somewhere below here. All right. And what will be your target? What are you targeting? You are targeting the length of the pole of the flag. This is the pole. This is the pole. So if from here to this point is 100 pips, this market will soon move 400 pips before any major correction will happen. As you can see here, you can approximately see that the distance from here to here is almost the same thing from here to here. All right. So this is how the bullish flag is. And we're going to hurry up in all of them because they practically move in the same, follow the same principle but different shapes. All right, this is the bearish flag. Now it's in the downtrending market. You see the red line here, red arrow, market is moving downwards. This is the impulse, and here is those corrections. Someone would have thought, oh, this market is not going bullish. No, when it breaks this area, you do what? You locate a sell position and enter the market and take it down. The length of the flag is also the target. So the target to be from here all the way to this area. Now the next pattern is the rectangle pattern, but in this place is the bullish rectangle. In this case, you can see how the market moved from here up into the rectangle, the place where it's now beginning to range. So this is a ranging market here now. A ranging market is showing up here. Price moved there and started going sideways. Okay, it's not the same like the flag. You can see it's not the same. It's the same theory but different shape. You can see this is a rectangle. So the breakout, if it's a bullish rectangle, you see price will enter from down, it will make an impulse into that level of ranging consolidation and now break out in the same direction of this impulse. So at this point, when the market breaks this area, you don't have anything to do with the downside, the support area, because you already know that the market is going upwards. I usually tell the students in Lagos here that about these chart patterns. When we're in the classroom, I do a lot of jokes with them. I tell them that, see, continuation pattern looks like when you are traveling from Lagos to the east. All right, we stop at different places. The first place we stop is Ore. All right, when we get to Ore, everybody will come down and we meet. That's what is happening here in this consolidation. We moved all the way from Lagos to Ore, and everybody came down. People are buying banana, buying snail, plantain. Some will go to toilet, some will go and wee, some will buy, the car will buy more fuel. People will stretch. That is what is happening in this consolidation. After that, what do? We continue in our direction. We begin to head to Benin. All right? So we are not, anybody who comes there to see us stretching, they might just think that we are going back to Lagos. No, we are heading to Benin. We know where we are coming from. We are coming from here, got to Ore, we highlighted and did a lot of rest and that, and then continued our journey. That way, when you remember your journey to Ore, it's very easy for you to recall rectangle continuation patterns. I hope that helps. Alright, this one is the bearish in the opposite direction. The same thing with the bullish, but now in a different market environment, in a downtrending market environment. You can see here, price broke it and retested it in this bullish candle. That's the small bullish candle. Here, this is what we call a bearish harami. Bearish harami. Please ensure that you study your candlestick pattern. Candlestick is very, very important. Candlestick patterns hold it tight. Support and resistance, know it. You know, even if you are dreaming, they just wake you up, what support and resistance, you know what it is. If they show you a chart as you are waking up, what do you think this market environment is, you're able to know. Alright? Alright, so this is a bearish engulfing here. So if you are trading this market here, you will have seen, oh, our direction is what? Our direction is bearish. Oh, I can see market move down here. That does not mean that when the market is doing this consolidation, it cannot look for opportunities to buy and sell. All right. So here, if I was the one trading when I got here and they put all the way back to this point, you know, I would have maybe secured some of my profits. At the moment I see these two candles, you can see these two similar candles, full body similar candles. We call it railway track. All right. Railway track is the reversal candle pattern. So at the close of this candle, I would have just entered another sell and get away at this point. Alright? And when these two candles, these three candles, 1, 2, 3, 1, 2, 3, the moment they form, this is what we call the morning star. Morning star is the bullish reversal. Okay? It's the bullish reversal. So when this three candle finishes forming, I'm coming at this point to take a short, you know, buy. Alright? And when this one got here, you can now see this green candle and this red candle has what we call engulfing pattern. Engulfing pattern is a reversal signal. You just immediately it's a reversal signal, you immediately sell. Alright? And at this break, price broke your support level and retested it. So this is what confluence. Previous level of support, this support here, support has broken and retested. Previous level of support becoming a level of resistance, and we call that confluence. That will give you an opportunity to do what? To enter the market. If you miss the entry at this point from here, you could have also maybe make this particular one. This is an engulfing pattern. This time a bearish engulfing. So you could have entered another trade here and got some pips. See, on higher time frame, one of these candles can be as much as 400, 500 pips. And I forgot to mention something to you. What are you supposed to be targeting? Like in the flag, we are targeting the length of the pole at the breakout here. The length of the pole is where you're going to target. So if from here to here is 100 pips, you're going to target 100 pips from the break of this point. Alright? But for the case of rectangle, your target is the height of this rectangle. So from here to here, that's what you're going to target from here up here. The same thing with the bearish. Now we move to another pattern. You can see the chart can do a lot. Excuse me. It can do a lot. In this case, this is a triangle. And this is what we call the ascending triangle chart pattern. It is also a continuation sign. It's a continuation sign. You can see and agree with me that market moves into this area and begins to consolidate. We have identified these different signs that the market will give. Alright? If it didn't show up as a flag, it will show up as a rectangle. If it didn't show up as a rectangle, it will show up as a triangle. And this is how we identify it. At the break of this triangle, market goes. Alright? And your target should be the height of the open end of the triangle from here to this point. Is what they are going to be targeting from here up we go. And you can see here again, at this break, there is what we call an engulfing pattern, bullish engulfing. This is a long candle that totally engulfs this small bearish candle here. Alright? This is what made it to break out on the upside. So this is the bullish, and here is the bearish triangle, the same as the previous one. And this small more triangle trends. Okay, it's a continuation pattern. After this triangle market is breaks, then it comes down. Okay, this is the same thing here. I'm showing you more examples. You can see that price moves from down to this region and begin to consolidate, and from here it broke. The moment it broke on this triangle, you can see what happened. It pushed all the way up. It's continuation sign. So when you identify your trend, what you're going to be looking for are continuation pattern. If it does not show up as rectangle, it will show up as flag or a triangle. And this is what we call a wedge. This is called rising wedge. Wedge looks like a triangle, but it's not actually a triangle because it has an open end. Unlike the triangle, you can say triangle closes, but this one really does not close. It's a wedge, a rising wedge, and you find this in a downtrending market. Prices have been coming from up, down, and start to do this. All right. So when you see it, you know that, oh, this is not truly a reversal. No, there's no such reversal as this. So how do you trade? At the break of this support line that you draw at the dotted line. From here, you do what? You enter a trade. Remember, I said this is a higher time frame, can be daily or weekly. So when there's a break, you move to a lower time frame, like the 4 hours or 1 hour, to see more price action here. This red candle we are seeing here, long candle. Okay, price did not really go boom to this place. No, if you break it, if you break it to the lower time frame, you will see some up and down move. You would have seen that market broke, returned to this point before continuing downwards. This is another one. This is another way to find it in a bullish market. All right. This is a falling wedge in a bullish market, and that's the resistance here. Price came into this area and begin to consolidate and correct and break this resistance line, that will continue. All right, this is the cup and handle. You can see it looks like cup. There is I saw this pattern recently and I laughed. I said, wow, these guys are giving me a cup of tea. Wow. And that is it. You can see all these lines here, you are the one that will draw it. You'll be the one to draw it. Price is coming all the way from here. So this is a bullish cup. Okay, it came up here and starts to consolidate. Round, and get to this point. And now we give you this cup. You put your resistance line here, support line on the back, down here. At the break of this resistance line, you look for a buying opportunity. And what will be your target? The depth of the cup. The depth of the cup, you draw a horizontal line across this, join this one to this point, and measure how many feet from here to the low. Alright? Whatever it is, that's what you are going to be projecting your target. Even though you can break those targets. If the depth from up here, down here is 200 pips, you can break your targets down. You can break your targets down to catch, you can break it down in 50 pips so you can manage your trade properly. And this is the inverse. This is the inverted cup and handle. This is market dropping into this area and does this kind of correction and pulls back to give us the candle. This is where we are going to pull our trigger when the price breaks this support line here, and then we can all the way come down. So from here to here will be the depth of this cup. That will be the same thing you will be targeting. Alright, so this is continuation pattern. So let's move to when the market has, the trend has exhausted. You know, the continuation pattern, we only use them in an uptrending market or downtrending market. And we said these downtrending markets and uptrending market will not trend forever. It has never happened. Price will go up, it will trend and come down. You that you are maybe you have some people in America here, you will not be in America forever. Sometimes you come back to Nigeria, okay? From Nigeria, you move back to America. Some who live in cities in Lagos, those who are from the east or in the north, right? If you're living in Lagos, after a while, you move back to the north, to Abuja. From Abuja, you come back to Lagos. So that's how it is for price too. The price will rise depending on what is happening in the economy. It will trend for, it can trend for 1 year in one direction. It can trend for 6 months in one direction, okay? right? So but that's not for you to determine when it's going to reverse. But there are signs that the market will show you that it is now ready for reversal. It's ready for reversal. So we have reversal pattern here, the bullish reversal pattern, and the bearish reversal pattern. I will go through them one after the other. Now, the first one is what we call the head and shoulder. Some people call it shoulder, head, and shoulder. Head and shoulder. This is the head, just like a human being. Your left shoulder and your right shoulder, you have the neck line. The neck line. So you find this in an uptrending market. So head and shoulder is a bullish market reversal. It shows truncation of that particular trend. Okay, I'm going to explain this. So well, this is another sign of it. All right, let me move to another. Okay, let's get back here. You guys confirm that you can see my new background. Can you see the new place? Hello?
Yes.
Okay, you can. All right. Okay. We have this. This is the way it happens. Just want to be as practical as possible. Market is trending up, down, up. It's making higher high and higher low. And then it comes here to make a high. And it comes here to make a low. And it's supposed to make another high around this place, because these highs there, this one you can see they are all higher. This particular high is higher than this one. So this one is higher than this. This one is higher than this. So the next high is supposed to be higher than this one. Alright? Let me do that again. I mistakenly clicked out. I'm sure you're following what I'm saying. Now there's a high and it did a low. Expected to do a higher high, but it could not. It did something here and now starts to fall. Okay, so this is the next line here around this area. You do something here to connect these two levels. To connect these two levels. So here is the left shoulder. Here is the head. And here is the right shoulder. So we call it head and shoulder, or shoulder, head, shoulder. So remember, if you are doing this, you would have drawn your trend line. Your trend line would have been drawn, and you are gently and carefully tracing this uptrending market. And at this point, these are the points that you are buying. You are buying at this point. Alright? So your first buy was here. Boom. It gave you 100 pips. And retraced back to the trend line. It bounced off. Boom. You buy. It gives you another 100 pips. It returns there, you buy. Boom. It gives you 150 pips. It got to this point, the price did not bounce, but it broke it. So whenever a trend line is broken, it's actually a sign that the market wants to do a reversal. But that is not the only sign. It's one of the signs that, oh, you can suspect that this thing that has been trending for the past 4 weeks in the up direction is getting slower. You know, maybe there is a change in the direction. Market's trying to change direction. Market's actually the master. So your responsibility is to master on how to interpret it, follow it, and hear from it, so you do not get messed up. Okay, so it broke here, which has never happened for the past maybe 2 months. It broke this line. Oh, you are one of the characteristics of a good forex trader is patience. You have to be patient to watch. And any trading decision you make based on several factors, the more data you have available to analyze and take a decision, the more variables that are supporting your decision, the more likely that your decision is going to be true. If you have fewer reasons to take a trade, most likely that trade may not go in your expected direction. So here, the price has broken the trend line we are watching. It comes to this level of support, and that's the neckline. It pushes up, okay? Maybe it wants to continue that this is a fake out. Is a false breakout. Majority think it's a false breakout. You can even label it a false breakout. Alright? At the bounce of this place, you might just take a trade. Now you are being very, very cautious. Okay? You are being cautious. You can see that these shoulders to an extent they are on the same level. Okay. It got to this point and pushed down. Oh. Meanwhile, that trade was supposed to from here to give you a higher high. After it has done this particular low, it's supposed to go break this level, the level of the head, supposed to break it, and now come and give you something higher here. So this is the high, which is the head. So for this trend to tell us, for the market to tell us that this trend is still continuing, it's supposed to make another high, but it failed to do it. So that failure indicates a loss in steam for the bulls. The bulls, you know, in forex trading, we have the buyers and the sellers. The buyers are called the bulls, that's their nickname, while the sellers are called the bears. It's like a tug of war. This one is dragging price down, this one is dragging it up. Alright? So at this point, the bulls were strong. At this point, they were still strong. They push it up. The bears will go down. The bulls will take it back up. The bears drag it down. That's the picture I wanted to have in your mind concerning this. And the bulls take it to this point. They were unable to drag it above their previous level of achievement. The bears drag them down. Oh, and it gives you this structure. This structure is what we call the head and shoulder, and this is how to trade it. Here is the neckline, okay? Here is the neckline. Here is the neckline. We've done about 1 hour. I'm not sure we started on time. Here is the neckline. But we'll soon be rounding up. So sorry about that. Now here is the neckline. This neckline must be broken. The break of the neckline, you can see when this thing has come up and is somewhere here, it's still not, you are not doing anything, you are still waiting because the conditions are not complete. One of the conditions that you must have is left shoulder, you have the head and the shoulder that come, and price begins to fall. Because the price can get to this neckline, which is the support, a very strong support line, okay? Very key, strong key level. You can get here and bounce up. You can get to this point and bounce. You can get here and bounce. And now come and make a higher high. The trend will not continue. You see, you can come and do that. And we are seeing this again. So market can come and do this and continue. So the trend will not continue. Alright, so that it has hit here, you are not ready to enter because all your confirmations are not complete yet. They are not complete yet. So there must be a break out on this lower side. Now the market is complete. The setup is complete. Now you begin to wait and look for selling opportunities. First, you join this level, the head and the shoulder, you drag it down. This has become your projected downtrending market, so you'll be watching it. So what happens most of the times is this: price will, if you're watching the candlesticks forming on that higher time frame, you saw it maybe on the daily or weekly, you see that price will break, and sometimes it will return to retest this neck, forming what we call confluence. Okay, and it makes this now strong enough to push it all the way down. All right. You can remember at this particular level, price had hit it before. As a resistance, it pushes it down. It comes here, breaks it, retests it at this point. This is the second point. It moves again and comes here to retest it the third time. It broke it here and retested it fourth time. So this neckline is the key level. So when the price has broken, retested, it's broken the neckline, retest it, then you are getting ready to do what? To take a trade. And this is what I will advise you to do. Don't be in a haste that, oh, this thing is right, so let's go on. Let's go ahead and do. You can just go ahead and you'll be stopped out prematurely. Okay? Okay, so what you do, if we see something like this, let me draw a scenario here. You can see when the market has broken, it will just be doing something like this in the lower time frame. This is where that neckline, was broken around this area. So this is the neckline. This is the neckline here. All right, and price begins to retest, go back like this, maybe the 4-hour time frame, and retest the neckline. So the moment it reaches there, I will advise you come and pick your trend line and draw. Join this trend line, draw the lows and join it. Okay? And join it. Now you are waiting to hit your trigger. You can at that point come lower here, somewhere here to put a sell stop, or you have to wait until the market comes and breaks it. So when it breaks it at this point, you are going to enter the market somewhere above the neckline, maybe about 20 pips above the neckline will be your stop loss. Will be the position of your stop loss. Alright? And your first take profit level will be here at this point when it has stopped, when it started to move back, which is here. Alright? Will be here. So you get entry here. Here is your TP1. So this level is your TP1. If you are following my signals, this is how I do it. This level will be your TP1. And now you come back here. The head, from this head to this neckline, is our target. Is our target. So if you draw an arrow, you can just draw an arrow and clone it. If you right click on that, you see clone. Clone, you keep it, then it has clone, you pick it up. And from the break of this line, you can see from here, is your target. So in this particular trade, you can have immediately have two take profits here. Two take profits. And listen, how to trade this thing. Two take profit. The first point here and then the second point here. You can either choose to open two trading positions. TP2. You can choose to open two trading positions. This is your TP1, this is your TP2, and here is your entry price. Entry price. Or entry point. At this level. You can use this green candle and drop the levels. Your entry here and this level is your stop loss. Alright? So, and that does not mean that when the market this your TP2 as if you are going to abandon this setup. No, the setup can have a potential of 1,000 pips. So you have to be in the market and be monitoring the pullbacks. So what will happen is this. This is your stop loss. Here, this is your stop loss. This is the entry. This is the TP1, TP2. Or you can decide to take just one position. If you take one position, maybe one standard lot, all right, when the price hits this level, when it hits this level, TP1, that takes the first profit level, TP1, if it comes to this point, and at this point you are not going to set any take profits. But this is your first level, target level, and then here. So the price, you're not putting any take profit order. If you want to trade it that way, there are two ways to trade it. You can trade about 4 positions or 3 positions on it, and position your take profit 1, 2, 3, 4 based on structure. Okay, so when the price hits TP1, it closes in profit. TP2, it closes in profit. TP3, it closes in profit. TP4, it closes in profit. That's one way of entry. The another one could be you are one position, okay, for this one, and you maximize your position, take all the recommended lot size. If that is 1,000, one standard lot, you take it. So when the price moves to the TP1 level, at this point you take partial profit. You take partial profit. I'm going to do you a short video on how to take partial profit. What that means basically is that when the price gets to this level, if you're on one standard lot, you are going to modify the order and put it on 0.5. Immediately you put it on 0.5, you are taking 50% of what you have already entered, 50% of the profit. So if the profit at this level is $1,000, you now change your lot size from 1.0 to 0.5. $500 will immediately be credited to your account. Why this one is running? What does that mean? Any other thing that is happening in this market does not concern you. If the price comes back and hits your stop loss, no issues. Okay? No issues. You have already gotten $500, but you are there waiting to take full advantage of the potential of this trade. So when this happens, you move this your stop loss. When you are taking partial profit at this level, you move your stop loss, okay, drag it to the entry level. To the entry level. When you have done this, when price was there and we get back to your entry level and touch your stop loss, no problem. It's zero. You just have 50% of what you have already gotten. But if it did not happen, and price most times, because this has huge potential, it will come to this level, to the take profit 1 level, and pushes the way down. Once it does and gets to this point, you begin to do what? Trail the market. You begin to trail the market. Trailing the market is you are dragging your stop loss from that entry now to take profit 1 level. So whatever it is from here to here will be $500. That one is settled. Price, market price, it will go up and then it will come down. You probably will come all the way down to this point and now begins to go down again. Alright? But why this thing is happening, you are not only in that position, you will also be taking additional positions. You'll be taking additional, I'm going to give you a video on how to do this. You'll be entering additional positions. You can see the market when it has gotten to 52 level, it does this kind of retracement again. Something similar. You come here and take your trend line, join these lows, you join the lows, okay, and wait for it to break. The moment it breaks and resets, we enter another trade. Another trade, by the time it's getting here, you are now on 2 positions and they are in huge profit. As it's moving, you are dragging your stop loss and accumulate the profit. And this can take 1 month. It can take 1 month, it can take 2 weeks. You are milking that market. So once you're already in a particular position, you can stay there forever. But some of our signal service, we understand that most of the traders, they are day traders. They trade and open their trades in one day. But for now, you have not discovered yourself to know what kind of a trader that you are, because you are still learning. You are still learning. By the time you do your mentorship, you'll be advised, not advised, you'll be required to take 45 trades. And after those, I'll send you, I'm not sure I've sent you these documents. The Profit Plus Trade Journal. If I've sent you that, we have just modified it. I'm going to send you this one now, the one you are seeing on the screen. That we're going to be recording your trades, having a very good record of all your trades. Okay, so let's move. That's how to trade both the head and shoulder, all of them. That's how to take those entries. But now we're going to continue to show you the rest of them. Please confirm you can see the new screen. Confirm you can see the new screen.
Yes, next
What?
New screen. It's a head shoulder.
Okay, all right. Thank you. You're right. Okay, so now that shoulder, head, and shoulder, neckline break, that's where you're entering the market. So the other one is the inverse. Remember, this one, the first one shows us when we are in a downtrending market. All right. So this one is when we are in the bullish market. Is this one? That's the extension, the truncation of a bullish market. So this is what a reversal sign shows. So when the market shows us this kind of a thing, we know that it's no longer continuing in the underlying trend. It wants to reverse. Now this one is a downtrending market. You can see it's been dropping for months. You can see here, this is May, here is June. You can see, and it started maybe around April, continuous falling, and it got to June, and it did this left shoulder, did the head, and the right shoulder. This one here is a failed arm. Market price supposed to come lower down here, but because it failed to do it, it shows it's the weakness of the sellers. The sellers are already losing interest, they are closing their trades and all that. So you see market price reverse. Here is the neckline. You can see the neckline here. It joins the point for the left shoulder and also the high point for the right shoulder. You join them. Alright? The moment you join them, 1 minute please. So the moment you join it, okay, the break of this neckline is where you begin to look for a trading position. All right. Now the next one is called double top. Double top. Remember, we are trading it the same way. The height up from the head to the neckline is your target in the case of the head and shoulder. But for the double bottom, the double top, price is making this an uptrending market. Been going a return, come back to this place and try to make a higher high. This is a high. So this is a low. This one is supposed to be a higher high, but it could not. It failed. It failed. That failure, all right, is a sign that the buyers are weak. Market price about to reverse, but that's not the only sign. You have to look for different things that will confirm it. If you have an idea of the fundamentals, affecting that particular market, you may know that this becomes a confirmation for you. But before it's valid for you to trade, the market price will come and break this neckline, which is a strong support area. You can see the support here. Okay? It will break it. The moment it breaks it, that's why we need to look for entries, just like I discussed in the case of the head and shoulder. Alright? So this is the inverse. This is called double bottom. When the market is in a downtrending environment. It hits a support, pushes up. It was supposed to make another low, but it couldn't make another low, but this is an equal low. Alright? We're having when the market is trending, you have higher highs, higher low, or lower lows and lower highs. There's no one of them that is equal, but this time something different has happened. So this is an equal low, which is called double bottom. So you wait for it, you are watching it. You are not trading around this area, no. You are patiently waiting for the price to break this resistance level in the next line. The moment it broke it, you can see the red candle. It came back to reset. You can pull your trigger from here, and the stop loss somewhere here, or maybe you can come as low as the double bottom level, and you can see how the market moves up. Okay, so this one is called the rounding top. Rounding top. It does not look like a double bottom, so double top. It doesn't look like head and shoulder, but it is rounding. It's rounding like this. So when you see it, put your support line here. When the price breaks the support line, you are looking to enter the market, and your target level is from here to here, from the high of that rounding top to the support line. And the same way for this one, your first profit level is from this low to the neckline. This bottom here, this level to the neckline, that's what you're targeting from here to the upside. So this one is the inverse of the rounding top, which is rounding bottom. Price has been coming down. You can't call this anything. It's a rounding, kind of structure. All right. So you come here, draw your next line. When price breaks it from, here, you are looking for a buying opportunity because it has reversed down into uptrend. Downtrending market has been reversed into an uptrending market. All right, so we've come to the close of today's discussion. So I would like you, if you have any question to ask, I'm here to answer your question. So I'm going to let you can ask me if you have a question. You can go ahead and ask.